Hi, everyone. Welcome to today's webinar. Thank you for joining this session on the California market. As you get started, a few reminders. Please use the Q&A section for any questions today, and remember to be constructive in any of those questions or comments to the presenters and to one another to ensure that we have a session that is productive. Also, AIA California will submit one AIA Learning Unit for those who complete this session live. And as always, the webinar content and additional resources will be available online shortly after the session. Today's webinar, which will focus on trends in construction and development, is presented by Supina Mapon. And again, this qualifies for one AIA Learning Unit for those watching live, which AIA California will report for those who finish the session in full. Now to quickly introduce our presenter. Supina Mapon is a healthcare strategist with DPR Construction with a background in healthcare consulting, design, construction, and business management. Supina is recognized for her ability to help healthcare clients navigate challenging environments to achieve transformational change and deliver optimal outcomes. She connects the dots between strategic intent and the built environment, leveraging her expertise in predictive analytics and operational design. She has worked at consultancies including Deloitte Consulting and SG2, and was instrumental in building the advisory services practices from ground up at architecture firms Canon Design and Keller Slater. Supina has a Bachelor of Arts from Stanford University and an MBA from the Kellogg School of Management, Northwestern University. Supina, thank you so much for being here. Please take it away.
Great. Thank you, Rebecca, for that introduction. So I'm going to grab the screen from you and quickly show everyone my screen. Rebecca, I'm just going to ask for a quick confirmation that you can see my PowerPoint.
Looks good.
All right. So again, everyone, thank you for joining us today. I am very excited to talk about all things related to California, how we're doing, and how it's impacting our markets. So it is a lot to cover in an hour. I'm going to do my best to give everyone a very high-level view of my opinion as to where we stand from an economic viewpoint, how we are doing as a nation, what implications that has to California, and of course, to break down insofar as it affects the office, retail, housing, higher ed, and healthcare markets. So just full disclosure here, my own background is in healthcare, so I probably know the most about the healthcare market. But the demographic and the economic impacts impact, of course, all these sectors. And so I will do my best to relay the trends that I've seen in these other sectors as well. So with that, we are going to jump into the national outlook. Actually, this morning, there was a new inflation report that was released, adding a little bit more to the noise that we've been seeing, right? So there's been a lot of headlines out there, some positive, some negative. And I would say that, it's been a little bit over a year since economists and the forecasting community start predicting, I think the US economy is going to fall into a recession within a year. There were lots of reports that said I have a 75% or greater chance of a recession occurring by the end of 2023. A few economists were even very bullish in saying that there's a 100% chance, which frankly is a level of confidence you never want to see an economist make. But by the beginning of 2024, we start seeing the media talk about a recession in terms of an if, as opposed to a when and then how bad. And some of the latest indicators have actually started to be a little bit more positive, which is great. So I will also preface this by saying that economic indicators are like the weather. So again, there's a lot of noise out there. And part of the difficulty in really interpreting all the signals out there is that there is usually a statistic, a report that's released at least once a week or so. And so just as pundits kind of change their stances because one day's news provides a different picture from the previous day, what we're doing here is we're looking at overall trend here. And I think, for all the noise that we're seeing out there, the US economy does not look that bad. There's really been some positive key indicators that are coming up. From a consumer spending viewpoint, household finances are actually strong. Household net worth has actually recovered from the decline that we saw in 2023. And again, like any indicator that, just to be confusing because they usually are, we are seeing household debt grow a little bit and more people are starting to spend more from a credit perspective as opposed to a debit perspective, the way they were in 2021 and 2022. But consumer savings is actually starting to rise. So that's why it's kind of cloudy, a little bit sunny indicators out there. And just jumping really quickly to inflation, I mentioned that inflation headlines, there was one that was just released this morning, just talking about the inflation rate, the consumer price index rate for July. So it is at 2.9%. And I will say that there was a lot of chatter in the news this morning when that came out, because that is the first time in a few years that rate has dropped below 3%. So, still above the Fed's 2% target, but it is trending the right way. June's rate was 3%. So this is very encouraging news, especially for the economists who are really looking eagerly for a rate cut beginning in September. All right, let's go to unemployment here. Job growth really has been kind of up and down this year. There was a report that was released just a few weeks ago that sent the stock market plunging. Lots of people were a little bit panicked, lots of worries about whether or not AI was a bubble. So this is one where you really have to take this figure in relation to other types of indicators. A high unemployment rate is not by itself necessarily bad. Usually a lot of economists and the Fed, what the Fed is looking for here is that they're looking for a way for unemployment to help control inflation, right? So there's a nice balance there. Whereas you have is indicators that you have people out there, there's a healthy job market. It's another way to control consumer spending, which is again another way to control inflation. So although the job market has been a little bit, again, as my word, lumpy, it's all kind of looking at the bigger picture. And then the last two here is we look at interest rates. The Feds in June emphasized a quote higher for longer approach to rate cuts, but the expectation now, especially with this inflation report that came out, is that they're expecting to cut about 25 basis points, about 0.25% from interest rates in September, potentially another cut in December. And of course, all of this affects our industry, right? Like cost of capital. Rate hikes have altered the landscape of borrowing, it's altered capital flows, especially in like very thin margin industries like the one I'm in, healthcare. It's one that's really caused a lot of stress. And so I have kind of cloudy, rainy here because I think it's going to take a little bit of time, even the economy starts to slowly recover, to get capital flowing again. So let's jump a little bit into GDP here. I'm going to have lots of charts. I'm going to talk everyone through what this all means here. But the key takeaway here is we heard this term stagflation over and over again last year. My question is, what stagflation? The US GDP in this past quarter rose at 2.8%. You can see here that actually was a nice kind of bump from the previous month here. And really, I think what kind of pleasantly surprised economists was that it was stronger than expected. So it came in at 2.8%, and the estimated GDP growth was going to be 2% there. So again, that was another kind of pleasant set of news for the economists who've been closely tracking this. And we're going to go into consumer spending. Sometimes I don't look at the percentages. Sometimes you look at what other companies are seeing, and services and entertainment have been really the buckets of services and goods that have really driven consumer spending there. Disney actually just announced that their theme parks are struggling. They really think, quote unquote, this is their quote, is a warning sign for the economy. Airbnb has also indicated that consumers are less willing to book in advance. So they're expecting a slowdown, right, in travel and entertainment. And movie and concert ticket prices have actually slowed down since May. Even Taylor Swift. And of course, I'm just kidding, because if anything is recession proof, it is Taylor Swift. This woman is amazing. She actually added $5 billion to the US economy last year, and her ticket prices sales have actually not been impacted at all. You still have plenty of people willing to travel internationally to Europe to see her and the Paris Olympics. So that's actually what gave consumer spending a bump last year. Some other things that we look at is credit card growth. So what we're seeing here is that consumers they're not actually dialing back spending, even with high inflation. They're actually just becoming better bargain shoppers. So this is actually a graph here by Bank of America. And what they do is they measure number of transactions by credit card and how much you're spending. So, early in 2022, people felt flush with cash. There was lots of spending. They were spending lots of money per transaction. What we're seeing here is that the number of credit card transactions actually has not really changed, but the amount of money consumers are spending has. So again, there's just a lot of bargain hunting going out there. People are now looking more for value and being much more price sensitive than they were in the past. And a really, really bright spot is that wages for lower and middle income households. So we're looking at households making under $50,000 and anywhere between $50,000 and $125,000. The wages are actually growing faster year over year compared to higher income households, right? So it's these kind of blue and red lines that we're seeing here. So for the last year or so, we've actually been seeing kind of an increase in terms of the bump here. So all of this has really good implications for the economy because you want to start to see the wage disparity and the disparities between the incomes start to decrease. All right, I'm going to jump into inflation. I really like this graph because it really shows how high inflation jumped really during the peak of like 21, 22, and why the Fed was so worried about it and started these really aggressive rate hikes beginning in last year here. So you can kind of see here, here's the peak, right? We had 9% inflation, just some of the highest inflation numbers seen since the 1970s. And now we're starting to moderate here. The inflation reports, again, came out at 2.9%, still below the 2% target. And forecasting out, they're actually starting to think, you know what, this 2% target might be reachable, maybe not this year, but maybe in 2025. So what people are projecting is that by end of this year, inflation will be about 2.6%, and maybe it will reach 2%, which is the Fed's goal by 2025. All right, let's go into the unemployment report. So this is if you guys invest in the stock market, if you have investments in NVIDIA or Meta or any of the tech stocks, you probably saw your portfolio take a huge dip in early August. That was a result of the job employment report that came out at 4.3%. And again, it's hard to see like the bigger picture. The stock market reacts to one data set, right? One data point from day to day. So this led to this flash crash in early August. Monday crash, there's a term that's called Turnaround Tuesday, which happened where the stocks went back up, and also Turnaround Thursday, which actually had a really good recovery. But the big question that this raised was, is AI a bubble? The NASDAQ, which is comprised of a lot of technology companies, was the one that was really impacted by this. It sank 3.4%, and you have all these investors really saying, hey, we have thrown all this money in AI companies. When are we going to start to see the turnaround? When are we going to start to see the profits that we are promised? So whether or not AI is a bubble still remains to be seen. But it just goes to show that, just how tech-centric our portfolios have become. And this is a fun little slide here. This shows all the rate hikes that the Fed has made just since 2022. You can see here, this is just additional rate hikes here and kind of where we got to. So at 2022, we are at 0.25, 0.5%, and you can see here that the funds rate raised it to about 5.5%, kind of like the subsequent meetings here. So right now, just reiterating, the Fed is expected to start to lower interest rates beginning next month, potentially another cut again in December. The question is how much? Most economists are saying, well, maybe they're going to cut it by 0.25%. The Fed is most likely going to wait for more data to determine exactly how big a cut that's going to be. And of course, businesses and anyone just trying to borrow money is saying, we want the Fed to cut 0.75%. We want you to be really aggressive. So it's a wait and see game. And then of course, this has all had implications on just higher cost of capital. It's been harder to increase inventories. It's been harder for our owners and clients to buy equipment, to finance their improvement process. This is just for your average consumer here. Just these rates here just shows how much credit card rates increased, how much home equity loans jumped, right? Just in a period of 3 years here. 30-year fixed mortgages, average rates rose from 3% to 7%. And of course, California saw really the brunt of this. However bad you see these rates here, it was much worse in California. Okay, so with that, construction projections, they can always vary a bit. This is actually a projection from Bank of America, who does quite a bit of research in terms of really collecting the amount of data, ABI starts, et cetera. So what we're actually seeing, what we saw last year was that the stress from rising rates didn't really spill into the construction industry, at least not yet. In July 2023, construction spending actually hit a record high $2 trillion, which is about 1/3 higher than it was pre-pandemic. And there has been some recent softness, right, in the Architectural Billing Index, if you guys are following that. But there's also been kind of accompanying optimism. So at least a lot of my clients, a lot of my owners they're taking kind of a wait and see approach or being a little bit more cautious with their capital. And they've really been focused this year on technology investments and optimizing their real estate portfolios. But the optimism really comes in that construction costs have been easing for the last year. And then cost of materials as well as supply chain factors have been more or less kind of getting back to where they were pre-pandemic. In terms of construction put in place, this is actually the split of where it was last year. So the big bulk of what drove construction dollars last year was residential buildings, especially for people, lots of Californians moving to Texas, moving to South Carolina, moving to Nashville, just places that are a little bit more affordable. So that drove a ton of residential construction, which is a large part of this bucket here. Non-residential, all your commercial buildings, anything not related to residential makes about 25%. Public construction, driven by things like the Inflation Reduction Act, other kind of public acts that have been meant to kind of stimulate public spending. And then public utility, 8%, this kind of miscellaneous bucket here. But what the projections that Bank of America is seeing is that they're actually expecting spend to be somewhat level. This is kind of where they estimated it in 2024. You can see some incremental growth. They're not being crazy here. Like they're not saying it's not going to be back to 2021 exactly, but it's kind of trending up here. So, and reading a lot of other reports, we're seeing the same thing. I think this is just kind of a lot of just cautious optimism being put in place, even if some of the strategic planning is being put on hold as people focus on optimization this year. All right. So with that, I'm going to talk about, I just drew a ton of data, you guys, talked a lot about what's happening nationally. I want to spend some time talking about what this all means for California. How are we doing as an economy? Are we going to bounce back? Are we seeing some, going to have some of that same optimism? And, this, some of you guys are going to hate this, but the forecast is still pretty murky, I have to say. I will say that if I made this slide, a year ago, it would have been negative. But since then, there's actually been some actually good measures that have come up in more recent reports, especially population. So if you lived in Los Angeles, if you lived in the Bay Area, even San Diego, you saw a lot of just higher income tech workers just moving out in droves, right? That out migration to other states they talked about. Well, last year was the first year since the pandemic that we didn't lose people. We actually gained 67,000 people. And so that was something that the Newsom administration has really been jumping on. They're being very bullish and saying, okay, this is like the end of the population bleeding. This is great news. I'm saying it's a little bit cloudy because there's obviously still cost of living concerns there. But the good news is that at least the massive hemorrhaging has stopped there from a population viewpoint. From a GDP perspective, our economy grew at 1.2% to start this year. Again, this is the lowest GDP growth that we've seen since the end of 2022. Inflation has been high and unemployment rates have been high. So in both cases, California's inflation rates, just a cost of living, cost of goods and services, as well as unemployment is higher, much higher than the nation's. And so I still have kind of a cloudy outlook here. Okay, so going back to that population graph, and this is so critical because it determines so many things, just in terms of what gets built, where it gets built, and also who are we losing and who is moving back into the state here. So the population, that 67,000 people, was really due to the fact that one, we aren't having as many mortalities due to COVID, which is good. There's a reduction in number of people leaving California for other states. If you didn't move during the pandemic, then you're more likely to now stay in place. And last but not least, and probably the most important, that there's a stronger influx of people now moving back into California from overseas, right? Like just legal migration coming back in. And historically, that has always been the biggest driver of growth for places like California. Now, I will caution this. 67,000 people is not a lot. That only represents 0.17% growth. So you can't really call it a surge, but it is indicating a more normal population pattern. We also can't forget that we actually lost 433,000 people between 2020 and July 2023. I tracked this really closely for the Bay Area. And what was really fascinating was really tracking who was leaving. And at least in the Bay Area, it was households making over $125,000. So it was something like we lost a few $billion worth of wealth from everyone moving out of the Bay Area to other parts of the country. And another surprising fact, the people we actually gained or who grew the fastest were actually Asian women, like older Asian women in 75 plus. The statistics were really funny on that. It was just kind of, people moving in, especially like multi-generational families moving in to help support a more mixed blend, hybrid families, as costs went up. So a lot of that was due to helping out with childcare. So you just had a lot of just older family members starting to move in to support that. And the numbers reflected that in terms of population gain. Okay. Now, here's the rub. So back a few years ago, I guess this is 2013, that, California was on this great growth trajectory. We had gone over the 2008, 2009 hump, and we were really bullish about growth. We said, by 2060, we're going to be at about 53 million people. We're going to double our population. It's going to be great. Now, the more recent population, because of all the people we lost, that new forecast is expected to be about 40 million people. That's a 13 million person delta between what we had originally forecasted and what we're projecting to forecast going forward in the future. You can see here that growth is pretty flat. Like we were pretty close to 40 million even before the pandemic, and now we're starting to kind of see this modulation here. So the projections have been severely thrown off, of course. And of course, a lot of businesses are reevaluating, hey, do we really want to stay here in California? Is this really, where we want to kind of set up shop for the long term? And this is also another kind of fun slide here. I looked really quickly at, okay, so we lost people, we gained people. Who are the winners and the losers from a population perspective? Population last year from 2023 to 24 increase in 31 counties. And a lot of that growth was actually Bay Area. So a lot of Santa Clara growth, a lot of Sacramento growth, Central Valley and Inland Empire. So Lathrop and San Joaquin was the largest growing city in California, and actually ranked 5th in terms of the Census Bureau's fastest growing cities here. I live in the Bay Area, so I was really surprised to see this headline where they said Emeryville is the fastest growing city in the Bay Area. And at first, I kind of was taken aback because Emeryville has been one of those cities that's been so dead for such a long time. But the one thing that these cities have in common is that they are all rapidly growing, like building houses, right? So a lot of this has to do with housing supply. And lower cost of living, maybe not in Emeryville, but Emeryville has a surplus of housing. Folsom, Stanton, Manteca, these three very much have to do with cost of living and the ability to do more remote work from different locations. And of course, I personally am seeing a lot of my clients start to do more builds in areas, especially like Central Coast, that I never thought they would enter. From a population loss viewpoint here, I mentioned that we lost a lot of higher income households. So about 220,000 households making over $150,000 left the state between 2020 and 2023. The biggest losers were California City, and I'm sorry, I actually cannot pronounce this. I'm sure somebody on the webinar can pronounce that city name, but it is in Kern County, and they dropped 12% and 7%. These cities in the Bay Area, San Leandro, Daly City, Nevada, Pleasanton, saw the greatest net losses. And then these two really got me, right? So San Francisco grew last year, but it still has 65,000 fewer residents than it did before the pandemic. So it still has not quite recovered. Still is not getting the strength that it saw pre-pandemic. And Los Angeles County had the largest decline of any county in the United States from 2022 to 2023. All right, let's talk about what California now is going to look like. So we saw that previous slide where reduced projections, now going to be closer to 40 million instead of projected almost 60 million before. This is a slide of how quickly we are aging in place. By 2030, you can kind of see this inflection point here. This is a year when Californian 65 and older are expected to outnumber the number of children, so people below 18. Right, so we're now seeing this rapid graying tsunami of people really coming in California here. This graph shows where they're expected to kind of settle by 2060 here. So a lot of Central Coast, a lot of SoCal, fewer people up in the northern area. But as we start to talk about the aging senior population, huge implications for that means in terms of need for senior living, healthcare services, chronic disease incidents, types of services to serve the geriatric needs. So this all comes into play with how consumers and businesses will start to need to look at serving this rapidly aging demographic. All right, so let me take you through some of the kind of not so good news here. I mentioned before that GDP growth across the United States has actually been pretty better than expected, whereas California has been at 1.2%, which year over year, that 1% to me is not a lot of growth. We ranked 29 in the nation in terms of GDP growth, and our unemployment last year really stunk. We were second to last in the nation in terms of highest unemployment rate. I think it was Nevada, one of the other states like that, who actually got the highest unemployment rate. So someone else beat us out, but that number 49, not great, especially when you take that into account with some of the other lagging indicators here. So, a lot of people have been saying, well, California has had much tighter monetary policy, which has really impacted a lot of our industries here, especially in real estate and finance and technology, right? Like a lot of the bank sectors, the Silicon Valley Bank, et cetera, started here. We had the Hollywood strike that happened in 2023. So our entertainment industry still hasn't really recovered yet. So, there's some bright spots though. I would say that our leisure and our hospitality retail industries are starting to bounce back a little bit. And then our education healthcare is still going strong from an overall spend viewpoint here. So lots of challenges ahead. And I'm going to talk a little bit about unemployment, which is the next slide here. Again, here's the US unemployment rate of 4.3%. California is at 5.2%. And I think the question that we have is the aging of the population and how that's going to impact the unemployment rate going forward. We know there's a shortage of workers across the board. I work with DPR Construction, and at least in the construction industry, there's already expected to be a shortage of 400,000 construction workers by next year. So, the situation is not getting any better. I mentioned before a kind of inflection point that's going to happen by 2030 if current trends continue. And you kind of see here that these are kind of where the employment has been kind of sitting here. Unfortunately for us, unemployment is still a percentage higher than it was pre-pandemic. So this is just something, again, we have to keep an eye on. We have to start to stimulate employment or get more in-migration of people who are of labor force participation age. All right. And I mentioned education and healthcare as being kind of bright spots in terms of growth here. This graph, if you are an industry sitting in this upper kind of right quadrant, this means that you are one, growing fast and you have a lot of workers, right? The size of the bubble indicates how many workers you have growing there. So education and healthcare is the fastest growing employer across the state here. Government, construction, and leisure and hospitality are the next ones here. And just for kicks, I wanted to compare tech employment just to see how bad the tech industry has really suffered over the last year with all the layoffs that are still happening. And you kind of see here that we had this kind of peak in 22 and this rapid decline just over the course of beginning with a year ago and just leading to this year, right? Like the numbers just went from positive to negative in terms of percent change. So these numbers lag a little bit. We're expecting to see a little bit of a bump because AI is really starting to reinvigorate the economy, the San Francisco, the Bay Area, the Los Angeles economies in terms of employment. So the expectation is that going forward, the employment numbers should start to look a little bit better. And I talked about inflation. There's not much to say here other than you guys have all seen it at the grocery stores, at the gas station. Our energy prices have, all have been a point of contention. We are just paying higher costs than average for housing, other services, energy, gas, etc., than other parts of the country, which is why population growth is expected to still be fairly flat going forward. So I'm going to talk a little bit about the outlook here. It's not all doom and gloom. I want to say that, the title of this presentation is 2024 is a year of stabilization and reset. And I think a lot of that noise has started to settle itself out. We're not seeing as much wild fluctuations anymore. The expectation here going forward from a projection viewpoint is that our GDP will start to stabilize. Our employment, though not great, will still stabilize. Unemployment rate will start to continue to go up as we have kind of an aging demographic, but incomes will go up. Household incomes will go up slightly. Migration will decline, right? So we'll still get more people. People have more money. And especially if the Feds do move forward with their rate cuts in September and December, that is expected to stimulate more growth and more investment in all the areas that impact our owners and our business. So, the outlook is cloudy. There might be some lag time for us to realize these improvements, but the expectation is that those years of wild fluctuation are mostly behind us, and we will start to see some, at least, stabilization going forward. All right, so I'm going to start to break this down again at rapid fire as to what this means by sector here. And for purposes of the discussion, because it's really hard to cover an entire state, I decided to focus on San Francisco, Los Angeles, and San Diego, at least a major trends that I could see in these three urban hubs here. This was a kind of a slide here that's a little bit sobering. If you live in the Bay Area, these office vacancy rates should not be a surprise to you. Before the pandemic, this is during the pandemic, but before people had a chance to really exit their leases, vacancy was sitting at 19%, and the most recent reading as of the summer, it was at 35%. So it's a negative 16% drop in terms of vacancy. San Francisco also is the most expensive market in the West, on the West Coast, and actually the second most expensive market across the nation, only surpassed across the nation by Manhattan. So still expensive, still have workers leaving, still having a lot of downsizing of office space that we're seeing, especially in the Bay Area. Los Angeles started out at 15% and improved to 17%. I'm sorry, did not improve, but up slightly by 17% there. But, again, not too far off from where you were pre-pandemic. Los Angeles, I think, benefits from being this global getaway market. The labor market is also slightly stronger in Los Angeles than it was even a year ago. And so we're starting to see a little bit of signs of life coming back in terms of a office vacancy viewpoint. And then from San Diego, actually doing slightly better here. So office vacancy started at 13% and then ended at 12% this summer here. A lot of that was actually due to life sciences. So I believe there was about almost 4 million square feet of life sciences office space that was built in San Diego in the last few years. And general trends to keep an eye on, right? Hopefully these are not too surprising for people, but what we're seeing from a trend perspective is lots of smaller leases. The expectation is that the under 10,000 square foot spaces should start to dominate from a leasing perspective from across most markets. We're also seeing a lot more hotelification as opposed to assigned spacing. And also a lot of employers need to create what they're calling quote unquote a boutique experience, because if you're going to have employees travel and commute, you now have to incentivize them to come back to the office, short of threatening their jobs. So there is that sense of that still that big resistance coming back that exists in California in a way that doesn't really exist for other markets here. Lots of landlord partnerships. The landlords are now willing to work with tenants to build more flexible agreements in their lease language. And then I think the last two, underperforming assets, I write about this a lot in that the way that we start to evaluate our portfolio of real estate assets, really, we haven't really changed it in the last 50 years. And so this new way of really evaluating underperforming assets has to be greater than just understanding occupancy rate and cost per square feet, but really the value per square feet, right? Like, are we making the best use of this office space? Are we really getting the type of collaboration, the creativity that we're seeing by forcing people to come back to the office? There needs to be new metrics for really evaluating underperforming assets in a way that didn't exist pre-pandemic. All right, I'm going to talk about retail a bit here. There is a really great quote here from a partner from Allen Matkins, who is a firm that really looks at the retail trends here. And so their quote was saying, as retail tenants change, they want the flexibility to pivot to different trends, incorporating more entertainment, more experience-based retail here. And we're just seeing a lot more changes in how your traditional retail spaces have been treated in the past. There's this term that's been floating around called zombie malls, right? So if you guys have passed a mall recently, it's most likely being shuttered or a lot of stores are moving out. Again, reference the Bay Area. Westfield announced a few years ago that they were exiting the United States market completely. The major retailers have left most of the San Francisco area. So it's projected that over the next 10 years, 87% of large shopping malls may close over the decade. But to that point of repurposing the malls, it's also expected about a quarter of those will reopen with some other purpose or having some sort of hybrid detail. And I know for the Westfield Shopping Center in San Francisco, there's been ideas thrown around such as saying, hey, let's make this massive 10-story pickleball courts. Let's like make it this really fun experience and let's make it immersive and let's really make it a way to attract people back to downtown again. So it's not a traditional mall, but it's a way just to reuse the mall or that mall space. The second trend is what we call the phygital shopping experience. Phygital is the mix between physical and digital. So we're seeing that a lot across many industries. Here's a really fun fact for everyone. Over 1/3 of Californians are now working either full-time or part-time at home. That is a lot of Californians, just at home and honestly probably shopping in between their free time online. So a lot of retailers are recognizing this and they are saying, okay, I want to give you guys the benefit of online shopping, but with the ease and convenience of having like a retail store close by. So the most successful retailers are the ones that have been successfully integrating this digital experience for consumers. I also mentioned again that price sensitivity is huge. So consumers are still going to be very price sensitive until the end of this year, probably into next year. They're doing a lot more research, they're doing a lot more price shopping. And so the idea is that total retail spend will start to moderate around 3% by the end of this year. E-commerce, again, all those people working from home, is expected to be about 20% of retail sales in the next 3 years. And retail sales actually is going to grow about 25%, 24% this year, which is massive. And then last but not least, lots of investment in technology, right? Lots of AI employment, lots of automation, lots of ways to kind of streamline operational efficiencies, make sure the supply chain is working, really making sure that we are able to deliver, your goods at the point of time as quickly as possible. Okay, I'm going to go into life sciences really quickly. But I think the life sciences market has been a little bit up and down. There's some sectors that have done very well. Kind of the pharma spaces, obviously lots of investments, lots of new drugs in development, new discoveries are happening every day that people are very excited to bring to market. So that's been a very bright spot. The numbers, especially I looked at VC funding for the Bay Area. It came in at $2 billion for Q1 of this year, which is it's a good number, but a deal count, again, there's still this kind of hesitation or this caution around really throwing yourself in, especially after some of the crashes that we've seen, the overinvestment that we've seen, right, because of people kind of jumping on the bandwagon. So deal count remained low at 51, down from a record 131 deals in 2021, and probably the least number of life sciences deals since 2011. So people are still kind of holding back saying, I want to see proof, I want to see evidence that my investment in this life sciences company is going to bear fruit. And San Diego is one where the statistics for life sciences has come up a little bit. San Diego has had 2.5 fewer life sciences job in the last year than the year prior. And then also there are more life sciences companies actually moving out. So then, in 2023 than there were in 2022. The bright spot is that public funding, so NIH funding and SH funding, life sciences life sciences organizations in California received $6 billion. So there's still a lot of interest, a lot of funding out there. And I think it's just from a VC perspective or a private equity perspective, you are the environment for those types of companies was very hot in 2022, and then they kind of got bit a little bit in the last year. So I think there's just still a little bit of caution. All right. We're going to go into education and a few more sectors, and then I'll be available to take some questions here. Education. So I've got this broken down both by K through 12 enrollment as well as higher ed employment. If you are if you have any school-aged children, in kind of in K through 12, you may have experienced this. I know in my area, we had a number of teachers who were on strike and really saying, you know what, healthcare costs, insurance costs have gone up 12%. My salary has not kept pace. We're facing lowering enrollment because frankly, Californians are not having as many children per family as they were in the past. So K through 12 enrollment has fallen for the past 6 years. And the greatest or the numbers I've seen, the greatest drop in enrollment has been Los Angeles, the Bay Area, San Diego. You can kind of see this graph in order of how quickly some of these cities have dropped in enrollment. This has huge implications for what this means for higher ed, because you want to continue to graduate as many seniors as possible so that they can continue to go to a higher educational institution. So from a higher ed perspective, California, the goal of California Newsom's administration is to aim for 70% post-secondary attainment by 2030. The Public Policy Institute of California suggests that enrollment will actually slowly increase into 2035, but then kind of level out. But the good side of what they're seeing here is that even though we're seeing declining K through 12 enrollment, the number of students completing the college prep courses required to be in the UC or CSU system has actually gone from 37% of high school grads completing the A through G course to over half completing the A through G courses, which means that they are they're prepping more for university, hopefully choosing to stay here in California. But again, the funding that we lose here from a public school enrollment has huge implications across systems. Again, we already have a shortage of teachers. And then salaries have just not kept pace with inflation and some of the other kind of healthcare costs that we've seen. So education is something that we need to keep a really close eye on, especially right as the population continues to age in place and the older generation starts to outnumber the younger generations. All right, housing. If you've sold a house in the last year, I am really sorry for you. Mortgage rates have not been kind to us. So but the good spot is this left graph here shows the median existing home price here. The last few months, we've actually gone down a little bit. Don't get me wrong, this median home price of $900,000 is still completely unaffordable and really, really high, but it's come down 0.8%. It's a step in the right direction. The affordability index is heading in the right direction, like you want to see this trend down. But the statistic that I researched was that right now only 17% of Californians can afford to buy this median priced home, right? So you've got 83% of the population that cannot afford to buy a home. And that's really, I would say, cost of living and housing were the number one reason cited by people leaving the state. You can't afford to buy a home, you can't afford to live here. So of course you're going to move somewhere where you can afford to live. So I think until we fix the housing costs, until we fix the cost of living, we're just going to continue to bleed people out. Okay, and my last sector is about healthcare. Again, this is the one I know the most about, and probably the one I'm actually the most optimistic about. So this is an industry where the aging demographics actually has a positive impact in terms of healthcare need. As you start to get older, you start to present with more chronic conditions. Most of the healthcare spend is directed at people over the age of 65 here. So from a healthcare demand and a need perspective in California, that outlook is bright. There's still enough growth there, and it's still enough scarcity of healthcare resources where if you're a health system, and actually, sorry, let me position that correctly. If you are a high performing health system, the outlook is bright for you. What we're seeing in healthcare, though, is that there's really been this divide between the hospitals who are really well positioned, they're well positioned before the pandemic, and the smaller community hospitals, the regional hospitals, the rural hospitals who are really suffering. So that gap is really growing. And because we're seeing this bigger gap between well-performing hospitals and hospitals who are not doing well, we're going to start to see more M&A activity. We're going to start to see more acquisitions as more hospitals go under. Okay, from a regulatory viewpoint, I chose to talk more about this because there are a lot of bills coming up that are going to impact healthcare. Healthcare spend has risen over 5% every year in California for the last 20 years. Again, I talked a little bit about the teachers and how their salary costs were not able to keep abreast with the healthcare insurance costs. At least in my school district, health insurance costs are expected to go up 12% next year, right? So this healthcare spend just has implications across multiple industries, all employers who have any type of employment insurance plan for their employees. More recently, in April of this year, the state regulators approved this new rule that is intended to limit healthcare cost increases to 3% beginning in 2029. And this is across the board. They're saying, okay, not only hospitals, but pharma, cost of medications, cost of materials, you guys are now limited to only raising 3% beginning in 2029. That is very ambitious considering that we have been kind of out of control of healthcare spend. But state regulators are starting to say we cannot afford these runaway costs anymore. We have to do something to start to keep track of this. The other big regulation that's happening right now that potentially could go through by end of this year is the SB 1432 bill that was introduced in February 2024. So if you're in healthcare, you most likely know about the 2030 deadline to make sure that your hospital buildings are seismically compliant under the Seismic Safety Act. What this bill does is that it extends this 2030 deadline to 2038. And so this is a huge boon to hospitals who, frankly, many of them can't make the deadline. According to HCI, right now, there are 3,340 buildings across 410 health systems that need to comply with this. And many of them will not make the 2030 deadline. So I know this bill is receiving a lot of report from the California Hospital Association. Most major health systems are supporting it. The UC Health System is supporting it. And the big question this raises are, what does this mean for capital planning going forward? What does this mean in terms of beginning to defer some of the, more immediate needs to renovate or to seismically retrofit a hospital versus some of the investments you've been taking off. So we are keeping a really close eye on this bill. A few other ones that I'll just throw out there for fun. There's another bill that's actually going to require private equity groups and hedge funds to get consent from the AG for any type of healthcare transaction. So this is a way that they're trying to rein in kind of crazy spend, and the kind of deals, the wheeling and dealing that I think that was perceived to have gone on in the last few years. Obviously, lots of groups that are not happy about this. So keeping an close eye on this one as well. And then the last October, Newsom signed Senate Bill 525, which raised the minimum wage to $25 per hour. About 500,000 California health workers will benefit from the law. On average, that gives them about $8,000 per year as part of their household, right? Which is, if you are making below $100,000, that's a significant add to your income there. So again, these benefits will help with consumer spend and would help with some of the other challenges that we've seen. And then last but not least, California this year became the first state to fund comprehensive healthcare for undocumented immigrants beginning January 1st of 2024. Again, this is another way to kind of rein in healthcare costs, and another way to make sure that everyone can receive comprehensive healthcare. Okay, so with that, that is my whirlwind explanation of all things happening across the state itself. I want to thank everyone for sitting with me through all the statistics and the data. And I welcome any questions. I know we just have a few minutes left, so I can either take the questions now if we have them, or I'm happy to answer them offline. My contact information is here. I'm happy to provide any information needed.
Thank you. There are a few questions in the Q&A. I can either read them for you if you want to go through and pull up the Q&A on your side. Either way.
Sure. Actually, Rebecca, do you mind reading it for me?
I
Quite see the chat
can.
right now.
Sure. The first one is, do the projections take into account climate migration? I think we can anticipate folks moving here because of the desirable climate.
Yes, although I will say that, it's interesting to note how many people have moved to Phoenix and to Tucson and to Scottsdale, and are willing to live in 120-degree heat, where you have stop signs melting because of the cost of living. So the projections, that's a very good question. I don't know if they directly take into account migration patterns due to climate change, mostly because the severity of the climate change that we've seen have been very sudden in the last few years. So let me take a rain check on that. But if I were to look at parts of the United States where we've seen the most outmigration, it is to places like Texas. It is to places like to Arizona and New Mexico, which I would argue do not have a desirable climate, especially if you are a hardcore Californian like I am.
All right, next question. Did COVID have an impact on population decline?
Absolutely. So in many different ways. The first was mortality rates. So mortality rates were extremely high during COVID, and we definitely saw that, especially in California, where we have a high percentage of people who were immunocompromised as well as elderly. So that's the first way it happened. Remote work, right, and ability to work anywhere had another huge impact. And then you also had just all the economic indicators that I've talked about that were impacted, especially in the last year, that raised cost of living, especially in California. So just kind of three ways. It wreaked havoc on our economy. It induced things like remote work, which gave people the ability to live anywhere. And there were just high mortality rates before the vaccines came out.
Thank you for that. Next question. Have you been tracking the construction of assisted living facilities in California? Running these facilities during COVID has been problematic regarding costs, staffing, etc. Is some of the out-migration of retired 65 plus associated with the availability of affordable assisting living?
That's an excellent question. I have been tracking that. So assisted living, any type of post-acute care, and you guys saw this, right, in 2020, 2021, where There's so many bottlenecks getting anyone into assisted living or getting them into residential care, not only because of COVID constraints, but also because of lack of staff and inability to do, I would say, efficient operational transfers from one side of care to another side of care. So the demand is far greater than our ability to provide for them. This is one where I would be very interested in tracking the private equity bill that I just mentioned. There have been a number of PE groups who have actually invested in, rehab facilities, IRF facilities, nursing homes, and assisted living facilities. If there's greater regulation that's going to happen in that space as it relates to being able to fund those facilities and keep them solvent, then I can see the supply not being able to meet the demand. So what I can say is that demand is far greater. And if you want to contact me, I'm happy to provide you exact numbers because we do relate the demand to the population growth, and we have the ability kind of by market. But I can say with absolute certainty right now that what's going to stymie that sector are available qualified healthcare professionals to staff those facilities, and the ability to fund and to keep those facilities solvent.
Great, thank you. The next one, planners call the silver tsunami. Planners call this the silver tsunami. I think you were talking about the 65 plus, happening soon, and have been aware of this for years. How is this demographic different in California than the rest of the country?
Mm-hmm. So I always look at there's an aging population, and you also need to look at the ability of the labeled labor force to support the aging population. So before the pandemic, you actually had a greater number of children and a greater number of adults from ages 18 to 64 who are able to support the aging community. What we're seeing now is the aging will make up 1 to every 4 and more beginning in 2030 and beyond. And so I always liken this to a society like Japan. So Japan is one of those societies that has a greater aging workforce, sorry, not workforce, a greater aging community than the workforce is able to support, right? Like a lot of them. But what saved Japan is that they have a very tight culture in which the elderly are cared for by the family members. And we don't necessarily have that here in California. So the question is, and the concern is relative to other states, which have a younger workforce, right? Because they've honestly gotten all of our workers, is what is the infrastructure that's going to be there to support the elderly? I'll speak to mine in healthcare. As we start to have more retired nurses, right? We have so many nurses who are going to retire, so many physicians who are going to retire this year. What is the infrastructure to support the elderly? Who is going to fund pay the taxes, fund the economy, et cetera. So that's a bigger concern, which is the impact that the declining labor participation rate will have, not necessarily the aging workforce.
Thank you. The next one is, how does the Bank of America spending information compare to other times in the economy when the economy is solid?
For transactions, I assume, or
I believe that this was very early on in the session when you had portrayed the B of A information.
Sure. Yeah, I can go back. I think the B of A information went to 2022. And 2022 was when people were feeling flush in cash. So that's actually probably a high, where they showed a ton of transactions, and two, a lot of money being spent because people had savings, they had the COVID funds, they were feeling really good about their stock portfolios. So I would say the B of A information for 2022 is very high and very optimistic and not indicative of a normal economy. And right now we're in like a depressed economy. So happy to go back and see what the data says in previous years. My guess is that it's splitting the difference between what we're seeing now and the flush of 2022. But typically, I think the price sensitivity that we're seeing right now among consumers is more than what we've seen before. There's a kind of a bucket of services. So it's called kind of the personal, consumer expenditures rate. And that always measures, like, it's a bucket of goods and services that, the Fed keeps track of. So the PCE rate has actually remained actually has increased quite a bit. So the question is, how much can you get, how much bang can you get for your buck? So let me actually put a pin in that question. It's a great question, and I will look back to different points in time, such as I would say probably 2012 to 2019. That's probably a good indication of a fairly steady economy.
Great, thank you. Well, here we are at our 1 o'clock hour. We do have a few open questions, but I will send to you, Subpoena. And if you would be willing to answer offline, we can send it out to attendees afterwards in a follow-up email. And just want to thank you so much for this incredibly informative presentation. It was so much information. It was amazing. Tons of thanks and appreciation in the chat and the Q&A. So just want to, mirror that to you. Thank you so much for joining us and just providing all this information for us.
Great. Thank you for having me.
Have a wonderful day, everyone.